And today, security is not just about war and peace, it's also about prosperity, what many experts call economic security. For example, is your national debt manageable? Do you have enough foreign exchange? All these factors determine economic security. And right now, South Asia is in a spot of bother. The entire region is facing three challenges: rising inflation, shrinking foreign exchange, and way too much debt. Some countries are worse off than others, like Sri Lanka and Pakistan. Others, like Bangladesh and India, have fared better. And two reasons for that. Number one, more resilient economies. Sri Lanka, for example, was dependent on tourism. So when the pandemic hit, tourism dropped to zero. And along with it, Sri Lanka's Forex. Compare that to India and Bangladesh, much more resilient economies. You have agriculture, you have factories, you have tourism. Basically, you have a lot of economic diversity. Reason number two is government policy. Sri Lanka was ruled by the Rajapaksas, Pakistan was ruled by Imran Khan, and that pretty much sums up what went wrong there. Out of these countries, Sri Lanka was the first to collapse and Pakistan could be next. We'll discuss that in a bit. But for the moment, let's focus on the biggest challenge in South Asia, and that is rising inflation. Let me show you some numbers. In India, inflation is at 7.79%, Sri Lanka 39%, Pakistan 13.8%, Bangladesh 6.29%, and Nepal 7.28%. So India is certainly better off, but the trajectory is not encouraging, which is why the Reserve Bank of India has acted again. They've hiked key interest rates by 50 basis points. The new lending rate is 4.9%. Now, what does that mean for you? It means that your loans will become more expensive and that your EMI payments will be higher. That's the idea behind raising interest rates, to discourage spending and by extension to cool off inflation. This is the second interest rate hike by India's central bank. Last month was a surprise announcement, but this time it was expected. And according to the Reserve Bank governor, more hikes could be lined up.
The MPC also decided unanimously to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth.
Withdrawal of accommodation stance, which basically means expect more interest rate hikes. The question is by how much? The last interest hike was 40 basis points. This time it is 50 basis points. If you keep hiking interest, spending will slow down. And if spending slows down, growth will suffer. So balancing these two things will be a big challenge for India. But there's an upside. India's Forex reserves look solid. They increased by $3 billion towards the end of May. Total reserves stand at $601 billion. That's always a safety net. But outside India, that's not the case. Take the Maldives, for instance. In 2020, their Forex reserves stood at $984 million. Now, $829 million. For a small country like the Maldives, this is bad news because their debt to GDP ratio is more than 100%. Out of this, external debt is 67%. The finance ministry says there is nothing to worry about, but analysts are spooked. JP Morgan believes the Maldives could default by the end of 2023. Over in the hills, Nepal is slightly better off. Their debt to GDP ratio is just 40%, but Forex reserves are a worry. In July 2021, Nepal had $11 billion in reserves. Today, around $9.75 billion. That's a 17% drop over 1 year. Both Nepal and the Maldives are victims of global uncertainty. They both earn a lot from tourism, but the pandemic drained that income. If the virus flares up again, both countries could suffer. So what do? One option is to protect foreign exchange. How? By banning certain type of imports. Pakistan has banned the import of 38 luxury goods. Nepal has banned the import of 10 luxury goods. And Bangladesh is also tightening import rules. The plan is quite simple. Uncertainties are always around the corner, so hold on tightly to those dollars. That is why they banned the imports. But what if the plan fails? Then we could see a balance of payment crisis. What does that mean? It means that a country does not have Forex, enough foreign reserves, to import even basic commodities. Sri Lanka has reached that stage. Nepal, Pakistan and the Maldives could be heading there. The question is, what must India do in a situation like this? Helping out is the logical option. India is already doing that in Sri Lanka, remember. India is sending basic supplies. It is extending lines of credit, even helping out with the IMF bailout. And now we say is the time to loosen the purse strings. If not, China will. They already have a modest foothold in South Asia. 17% of the Maldives' national debt is owned by China, 6.8% in Bangladesh. Compare that to India. India makes up just 1.3% of Bangladesh's debt. In Nepal, China has signed projects worth $2.4 million. So if crisis comes, China will play hardball. Again, just look at Sri Lanka. China has refused to restructure debt in Sri Lanka. Instead, they want to refinance, which basically means China wants to issue a new loan to deal with older loans. So an economic crisis in South Asia could be a security threat for India. And to prevent that, India must whip out the checkbook. It must play the role of South Asia's natural leader. WION is now available in your country. Download the app now and get all the news on the move.